Good morning, everyone. So today's session would be a revisionary class on Ind AS 33, that is earnings per share. So I presume you would have access to the original session where we had discussed this in detail. So my coverage right now would start with those areas of Ind AS 33 which are specific to the CA final level, and then we would proceed to look at the common aspects which you have already covered. Okay, so as you know, Ind AS 33 has a comparable standard under the IGAP regime also, that is AS 20. So a large number of concepts are similar, a large number of calculations are also similar, and therefore certain introductory areas I will just defer it towards the later part of the session so that we can cover first what is primarily important from your examination perspective and from CA final perspective. Okay. So, but I will just briefly rush through that and then we will look at the CA final areas in a little bit of detail. Okay. So, when we come to EPS, earnings per share, all of us know that this is a very vital number, a very crucial number that appears in the financial statements. In fact, the significance of this number is so high that this does not get buried into your notes. Rather, it forms a part of the face of the P&L itself. On the P&L, after you disclose the profit after tax and the OCI, below that you typically have the earnings per share disclosed. That significant it is because this is the one number that links the market value to the book value. If you are aware that there is a multiple which is known as a price earnings multiple, so typically, the PE multiple and the EPS both together will be used to arrive at a forecasted value of the share. And that is one of the critical matters that analysts typically like to view. And therefore, EPS as a number gains significant importance for disclosure purposes and reporting purposes. Okay. Now, when we talk about EPS, EPS is always from the perspective of the equity shareholders. Okay. Now, which equity shareholders? Those equity shareholders which are subordinate to all other categories of shares. From that perspective, we calculate the earnings per share. What do you mean subordinate to all categories? Suppose you have equity shares, class A, class B, class C. Suppose you have preference shares in the nature of, preference shares. All of them put together, you have to look at that category, which will be the ones who will be standing last in the queue to receive the assets at the time of liquidation. Those category of shareholders or those category of shares are the ones with respect of which you are going to calculate the earnings per share. Okay, so that is why we need to be very clear from whose perspective we are going to calculate the EPS. Okay, it's never for equity as a whole. You can have preference holders, you can have equity holders of different categories, differential voting rights. But that class which is subordinate to all other categories of shares, from that perspective, we calculate the earnings per share. When I talk about EPS, what is the formula that you have in mind? Very simple, earnings divided by number of shares. So in a slightly polished language, we call it as net profit attributable to equity shareholders divided by weighted average number of equity shares. Weighted average number of equity shares. So what is net profit attributable to equity shareholders? Again, that profit figure which will be there for those category of shares subordinate to all other classes of equity shares in issue by the company. So that is your net profit attributable to equity shares, equity shareholders. Coming to weighted average number of equity shares or what we call as WANES. So why do we call it as weighted average? Why can I not simply use your number of equity shares in the denominator? Why can I not use simply the number of equity shares sitting in the denominator? Well, uh, what is important is the standard looks to actually evaluate the EPS from the perspective that for how long the entity has been able to use the capital that is in issue. For example, if I have made an issue of equity shares on 1st of January of a particular financial year, then these equity shares are there in existence only for 3 months, Jan, Feb, and March. If I have to do a normal number of equity shares in the denominator, what would happen is I would have received capital for 3 months. So I would have carried out the operations using that capital only for 3 months. But if I do not weight it for time, WEIGHT, if I do not weigh it for time, then the repercussion will be such that the profit for 3 months would be divided by the number of equity shares as if it were there for the entire year. And therefore, the standard says that no, you cannot take normal equity shares. You have to take a weighted average number of equity shares. Weights being the period for which the shares were in issue. So in this case, if the shares were issued in the month of January, assuming 1st of Jan, then whatever is the number of shares, you will multiply it by 3 by 12, because out of 12 months, it was in issue for only 3 months. And this number you would take as the denominator and use it to divide the net profit attributable to equity shares. Is it okay? So that is the first thing. Why do we use weighted average? The weights being the time weight, the number of the period for which the shares were actually in issue. The second aspect of this is what happens in the case of partly paid up shares. Many times you would have shares where you get partly called up, shares which are partly called up. In that scenario, we should convert them into equivalent fully paid up shares. We would have to convert them to equivalent fully paid up shares and then include them in the weighted average number of equity shares calculation. Fair enough. Okay. Now we have two things. That is, one is issue of bonus shares, issue of right shares. We will look at these parts later because they are largely a repetition. If I start discussing this, it will take at least another half an hour or so. But just remember that bonus shares are typically free shares. That means you have increased the number of shares without receiving any money. So basically, you are capitalizing your reserves. And when you capitalize your reserves, basically these shares were already in existence in the form of reserves. Now from reserves, you are bringing them into share capital. So what happens is in the case of bonus shares, you typically not only do the calculation for the current year, you also restate the previous year's calculation. What do you do is when you have shares which are issued without consideration, then you will be calculating the EPS from the date the earliest numbers are represented, from the date the earliest numbers are reported. Okay. So if there is a bonus issue that is done in the current year, you will not only report current year EPS, but you will also restate the previous year's EPS. You will also restate the previous year's EPS. Why do I do that? Well, we do that because the number of equity shares is at the reporting date. Suppose it is 31st March 26. This would be including bonus. Fair enough. Now, what did I say? Bonus shares are already in existence. You are not going to get anything extra. So including bonus 31st March 2026, this is the number that is there in your financial statement. Calculate this for 25-26, I will calculate as if the bonus was already present, as if the bonus was already present. So for the entire year, it will be the shares for which I received consideration plus the bonus shares for the entire year. Now, when you reported 24-25 numbers, that is EPS for the year ended 31st March 25, you would obviously not have the bonus included in that because you did not know at that time you would be going for a bonus. And it was not even in existence. So you would have reported the EPS based on the number of shares for which you have received a consideration. So here, the reported number would typically be excluding bonus. Excluding bonus. Now the problem arises is when I, without modifying, if I just prepare and present these two financial statements, what will happen is that this number is capturing the bonus impact. This number does not capture the bonus impact. So your denominator in 25-26 is higher, your denominator in 24-25 is lower, when in fact there is no fund flow that has happened at all because it is mere capitalization of reserves. So naturally, when these two things are there, 24-25 will show a higher EPS because of a lower denominator. So to avoid that anomaly or to avoid that specific issue, what they say is for 31st March 25, that is the EPS of 24-25, you will have to restate the EPS. You will have to restate the EPS. Is it okay? Yes, fair enough. So you will have to restate the EPS. So then these two is what will be comparable. These two is what gets comparable. So that is about bonus shares. Right shares have a similar concept because right shares are basically shares which are issued to the existing shareholders below the market rate, which are issued below the market rate. So there is a bonus component in that. Of course, it won't be a complete bonus like how it is for bonus shares, but in that there is a component of bonus. So we will have to eliminate that. We will have to eliminate that. So we use something known as a rights adjustment factor. We'll come to that towards the later part of today's session because that is something which typically is a repetition, a carryover of what you have already studied in your intermediate. Okay. Now coming to the next part, that is the numerator. That is the numerator. What did I say? It is net profit attributable to equity shareholders. Those equity shareholders which are subordinate to all other categories of shareholders in the company, in the company's capital structure. Okay, now when we talk about net profit attributable to equity shareholders, what is this equal to? This typically will be profit after tax because that is what is attributable. Yes. And then from here, you will have adjustments. You will have adjustments. Okay. Now, what are the adjustments? See, first of all, preference dividend. First adjustment is preference dividend. Okay. Now, your preference dividend is typically the amount that is payable or the dividend that is calculated or computed on the preference shares which are in issue. Now, when we talk about preference shares, these would typically fall under two categories. Preference shares which are redeemable, which is in fact the case under the Companies Act, where you can only issue mandatorily redeemable preference shares. Mandatorily redeemable preference shares. Okay. So if that is the case, under financial instruments, your preference dividend would actually be reported as a finance cost because the preference shares are not share capital. They would be reported as a financial liability because you have an obligation to deliver cash. And when you have an obligation to deliver cash, because it becomes a financial liability, it goes and gets recorded at your fair value, and then you do the amortization table, etc., etc. So therefore, there would be a finance cost element relating to these preference shares already in the P&L account. When you arrive at PAT, the PAT is after deducting the finance cost, and the finance cost includes the interest which is calculated at EIR, your effective interest rate, on the preference capital which is in issue. So that would already be deducted. So in the case of preference shares which are classified as a financial liability, no further adjustment is needed because this would typically go as a finance cost in the P&L. So the first case would typically become financial liability. We discussed this. Now, equity. Well, Indian Companies Act does not allow you to issue preference shares uh, which do not have a maturity, a mandatory maturity. But this is a reporting standard. Okay, so we will not look at it from a narrow prism of Companies Act applicability. We will also look at how the standard actually looks at, how the standard actually envisages things. So if my preference capital is classified as equity, then the dividends on that also would go and sit in your appropriation account. It would not sit in your P&L account because dividend in such category, in such a case, would become an appropriation of profit. Interest is a charge against profits. Here it would be an appropriation of profits. So in this case, when it is equity, you have two scenarios: cumulative, non-cumulative. Cumulative means dividend accrues every year. Whether you pay it or not, dividend accrues. When you pay, you have to pay for all the accumulated amounts. Okay. So cumulative, what you will have every year, you will have dividend that is debited. Every year you will have dividend that is debited. So every year when you are arriving at your net profit attributable to equity shareholders, you will take PAT and reduce the cumulative dividend every year in respect of cumulative preference shares which are in the nature of equity. If it is non-cumulative, you will reduce it only if it is declared. Only if it is declared. If it is not declared, you need not do any further adjustment. You need not do any further adjustment. Are we okay with this? Yes. So the first category is first adjustment is preference dividend. Second adjustment is typically your premium or discount on early settlement. Okay. So when we talk about premium or discount on early settlement, see, suppose you have preference shares which are having a 20-year maturity. But suppose your cash flows became so good, so nice, that you thought of redeeming it at the end of 15 years itself. You have cash, you can pay off the liability. So you say end of 15 years only I will pay. Now, if that is the case, if there is an early redemption, and there is a premium on early redemption, then that would have been adjusted in the retained earnings of the equity. This is as per your ICAI questions, whatever principle they have followed. Okay. So your premium discount on early redemption would have been adjusted in retained earnings. No impact is given while calculating the PAT. So therefore, you need to arrive at a separate adjustment to give the correct PAT figure while calculating the basic EPS. Okay. Now, when we talk about early conversion, the institute presumes that this would already have been included in the finance cost. What? The premium on the conversion. So since this would already have been included in the finance cost, No further adjustment is needed. No further adjustment is needed. Okay. So you will have to remember these two things in mind. You will have to remember these two things in mind. Okay. Now, third category or third adjustment, any other expense which is ordinarily deductible from P&L, but you also allow certain other reserves to adjust it. Okay, like for example, premium on redemption. Premium on redemption. If you have securities premium balance, typically you would adjust it against securities premium. But if you adjust against securities premium, you will be unable to adjust it against the uh, you would be unable to adjust it against the P&L. So what you do is you start with PAT, and then below that you say less premium on redemption of preference shares adjusted against securities premium. Write that, and then that net figure is what you will use to calculate your EPS. Okay, so that is largely what you have in terms of adjustments to the numerator. In terms of adjustments to the numerator, are we okay with this? Yes. Any doubts? No doubts? Okay, so let us move on to the next one. And now we come to a category. So this was the very, very basic thing about EPS, which we have covered. We now move on to the next category. That is topics which are more aligned with your CA final coverage. We'll do that right now. Okay. So the first one is participating preferences. The first one is participating preferences. Now, what do you understand by participating preferences? These are shares which are entitled to dividends based on profits. They have a share in the profits also. They have a share in the profits also. So how do I calculate my EPS is something we will have to go through. Okay, so just let us look at this. Okay, all right. This is a question from your study module only. An entity has two classes of shares in issue. 5,000 non-convertible preference shares, non-convertible, and 10,000 ordinary shares. Okay, so you have two categories of shares. Now, what did I say? Your EPS is from that category of shares which is subordinate to all other classes of shares. So between these two, which is the most subordinate? The ordinary shares, the ordinary shares. So when this is the most subordinate, so EPS also will be calculated with reference to these 10,000 ordinary shares. Preference shares are entitled to a fixed dividend of rupees 5 per share before any dividends are paid on the ordinary shares. Ordinary dividends are then paid in which the preference shareholders do not participate. So first distribution to preference shareholders, if there is it, remove that. Then you look at the ordinary dividend. So when the ordinary dividend is being paid, preference shares will not have any claim on that. But if there is any additional ordinary dividend, every preference shareholder then participates in any additional ordinary dividend above 2 rupees at a rate of 50% of additional dividend payable on an ordinary share. So this is not a typical preference share. This preference share is not only getting the 5 rupees fixed dividend, it is also getting a dividend based on the profits that the entity has earned. That is why they call it as a participating preference share, because it participates in the profit sharing. It has a participation in the profit sharing. The entity's profit for the year is 1 lakh and dividends of 2 rupees per share are declared on the ordinary share. Compute the allocation of earnings for calculation of basic EPS when an entity has ordinary shares and participating in equity instruments that are not convertible into ordinary shares. Okay. So now Let us look at this. The first thing is your earnings. The first thing is your earnings. So you have a profit of 1 lakh. Dividend of 2 rupees per share is declared on the ordinary shares. So when I have your calculation of undistributed earnings, profit minus the dividends, preference dividend 5,000 shares into 5 rupees per share. This is the fixed amount. Ordinary 10,000 into 2, this is the 20,000. So typically you have 55,000 balance as undistributed earnings. Now, ordinarily, who is the custodian of this 55,000 rupees of profit? Who is the true owner? The true owner is the ordinary shareholder. Ordinary shareholder. But in this case, I also have a participating preference share. I also have a participating preference share. What do you mean by participating preference share? The preference shares in issue are also having some amount allocable to them in respect of this 55,000. They have an amount allocable to them in respect of this 55,000. So, yeah, yes. So that is why you typically cannot treat this as a normal share. It becomes a special share. Okay. Now, how do we do this? How do we do this? Okay. So I will have to factor in the amount of participation that the preference shareholder has to arrive at a true calculation for my ordinary shareholder. So let us assume allocation per ordinary share is A. Now, if you look at the question, every preference share participates in any additional ordinary dividend above 2 rupees at a rate of 50% of additional dividend payable on ordinary share. 50%. 50%. Okay. So allocation per preference shares, if I call it as B, then B is 50% of A. B is 50% of A. So the equation will be allocation per ordinary share into 10,000. What is 10,000? The number of equity shares in issue plus 50% of A into 5,000. 5,000 is the number of preference shares. 50% of A is what is attributable to it. So this total gives you 55,000. This total gives you 55,000, which is nothing but the undistributed profits. Now, on these profits, you have the ordinary shareholder also, and you have the participating preference share also. So 55,000 will be shared by both of them, A and B. So when I solve this equation for A, then A falls to 4.4. When I solve it for B, it falls for 2.2. It falls to 2.2. So therefore, when I talk about my preference shares, the dividend, the distributed earnings is 5, which it is ordinarily entitled to. And undistributed earnings, it is getting 2.2. Undistributed earnings, it is getting 2.2. So therefore, total is 7.2. And now when we talk about this, ordinary shares is 2 rupees, which is already distributed, and 4.4 is on the undistributed. So therefore, total is 6.4. How do I check this? Well, 5,000 into 7.2 for the preference shares. 10,000 into 6.4 for the equity shares. Total comes to 1 lakh, which was your profit. Yes. Are we able to understand this? Yes. Are we able to follow? All right. So that is something that you calculate based on that particular working. Okay. So now illustration 60, I will just give 2 minutes. Okay. So illustration 16, profit, ordinary shares outstanding, non-convertible preference shares, non-cumulative annual dividend on preference shares 5.5 per share. After ordinary shares have been paid a dividend of 2.1, The preference shares participate in any additional dividends on a 20 is to 80 ratio with ordinary shares. Compute allocation of earnings for the purpose of calculation of basic EPS when an entity has ordinary shares and participating equity instruments not convertible into ordinary shares. So a similar question that you will have to do it. So I just give you 2 minutes. Just read this question and then let us proceed. It's the same like the last one. Should not have any challenge in calculating. Okay. Just give me a minute. Okay. So with that, participating preference shares are done. So we now come to the next category again, or the next section. Again, something that you are already aware of, uh, and that is diluted EPS. Diluted EPS. Okay. Now, what do you mean by dilution? Okay. Basic, we have already seen. That is a present scenario, a reported scenario. Okay. Now, many times what happens, your capital structure would have certain instruments which are convertible into equity in the future. So, the key point that we are looking at is if the company continues to perform in a similar manner, if the company continues to perform in a similar manner in the future, what would be the impact on EPS if the potential shares which are there in your capital structure get actually converted into equity shares? So, in a manner, a diluted EPS is a forecast number of the worst possible EPS that is there. The worst possible EPS, why do I say that? Because when you start figuring the potential equity shares conversion, your denominator will start increasing because denominator is number of shares. So you will not only include the current shares, but also add in those instruments which can get converted into equity shares in the future. So you will typically consider that also. So operational numbers remaining the same, if your number of shares increases, your EPS drops. EPS drops को बोलते हैं dilution. When your EPS reduces, we call it as dilution. And we are interested conservatively in the maximum possible dilution. So therefore, worst common EPS, worst possible EPS is something that we are interested in, So when I talk about potential equity shares, what are they? convertible preference shares, convertible debentures, options or warrants, and contingent shares. Four categories. So you have four categories: convertible preference shares, convertible debentures. Third one is options or warrants, and fourth one is contingent shares. Now, when we do the calculation, what do we assume to be the conversion? We assume that the conversion is assumed to happen at the beginning of the earliest reported period or at the date of issue, whichever is later. So suppose if I have already convertible debentures in issue, then this convertible debentures is something that I will assume is already converted at the earliest reporting date to arrive at parity in comparing the numbers. If it is not issued for throughout the period, but the issuance happened in the middle, then from that date we will calculate the uh, what you can say, we will calculate the diluted EPS from that date. Okay, so that is your second one. What date should we assume for conversion or exercising? Okay, so that is one. Now, conversion of potential equity shares should dilute the EPS. It should reduce the EPS. If you have certain instruments where your diluted EPS increases, where your diluted EPS increases than the basic, in such scenario, you cannot consider and report that. You cannot consider and report that. Okay, so therefore, if the potential conversion increases the EPS, the securities would be regarded as anti-dilutive, and therefore they would be ignored. And therefore they would be ignored. Okay. Now, you are not supposed to get into any decision as to whether the investor will do the conversion or not. That is not our job. Our job is to report the diluted EPS based on the data which is given. Just assume that and proceed. Okay. Next, when we talk about potential equity shareholders that I have to factor in, I will also have to calculate certain adjustments to the numerator, For example, if I have cumulative preference shares, that is something that you will consider to be converted, number one. Second, numerator, you will add the preference dividend, because going forward it was converted, so you will not have any preference dividend hitting the appropriation account. So add back the preference dividend and add back the number of shares issued. Okay, so that is typically what you add for the numerator and the denominator. When we talk about convertible debentures, I will add interest, but interest is tax deductible. So interest into 1 minus T is typically what you will add. And denominator, you will add the number of shares issued. Are we okay? Yes. So typically when we do your calculation, this happens as per financial instruments. So therefore, in the event of a potential conversion, interest would be the effective interest rate. Okay. So are we clear with this? Yes. Are we clear? Any doubts so far? No doubts. So when you will be calculating the conversion, all possible impacts should be treated, not just your savings in interest. Savings in interest can increase the profit. Can increase your manager narrator's remuneration. Increase in that can save your tax. So you have to factor in all the things that are there to arrive at your EPS. Are we okay with this? Yes. Are we okay? Yes. Any doubts? No doubts. So let us do one thing. Let us see that one question which is there. Yeah. Entity A has in issue 25,000 4% debentures with a nominal value of rupee 1. Just go through this question. Entity A has an issue 25,000 4% debentures with a nominal value of rupee 1. The debentures are convertible to ordinary shares at a rate of 1:1 anytime until 20x9. The entity's management receives a bonus based on 1% profit before tax. A's results showed a profit before tax of 80,000 and a PAT of 64,000. For simplicity, tax rate of 20% is assumed. So calculate earnings for the purpose of diluted EPS. So we start off with PAT 64,000, which is given. Now when the conversion happens, interest will be saved. Yes, 25,000 into 4%, add 1,000. And because interest saved will increase the profit. Increase the profit will also increase the tax. So 1,000 into 20%, tax expense will go up. Next, increase in management bonus. Increase in management bonus. They have given receives a bonus at 1% of profit before tax. So profit went up by 1,000. So 1% of that is 10. You will reduce. Because 10 is hitting the P&L, you will have a tax benefit of 20% into 10. So 2. So total earnings is 64,792 rupees. Are we okay with this? Yes, are we okay? So I considered not only the savings in interest, but savings in tax, and then additionally whatever is there that what you have to say, whatever is there that uh, is the fallout of the conversion, is the impact of the conversion. You will have to consider that also. So I considered interest, tax saved on that, additional management cost, and tax saved on that. So that gives you 64,792. Okay, so that covers your numerator impact. Okay. Next. Just a minute. Just looking at the questions that are there. Okay, okay. Now, options and warrants. Okay, options and warrants. Okay. What do you mean by options and warrants? Okay. See, in the case of conversion of debentures or preference shares, no additional consideration is received. In the case of options, you generally get some cash consideration. You generally get some cash consideration. So what you have to do is you have to only calculate the free portion of the issue, and that would typically be treated at par with how you treat bonus, etc. Okay, and the portion which represents the cash portion at the fair value, that would be regarded as a regular issue. That would be regarded as a regular issue. Okay, so what you have to do is, in the case of options, the cash consideration would be received on the exercise. As this consideration is ignored, shares to be issued at fair value against this consideration should also be ignored. Therefore, adjustment would be made only for potential equity shares which may be issued without consideration. That is your free element. That is your free element. Okay, so now just a minute, I'm looking at the questions which are there. Okay, yeah. So this is what we can solve. At 31st December 20x7 and 20x8, the issued share capital of an entity consisted of 40 lakh ordinary shares of rupees 25 each. Entity has granted options that give holders the right to subscribe for ordinary shares between these years at rupees 70 per share. Options outstanding at 31st December X7 and X8 were 6 lakh 30. No grants, exercises or lapses of options during the year. The profit after tax attributable to ordinary equity holders for the years ended 31st December X7 and X8 amounted to rupees 5 lakh and 6 lakh respectively, wholly relating to continuing operations. Average market price of a share is 120 as at December 20x7 and 160 as at 31st December 20x8. Calculate basic and diluted EPS. Basic EPS is very simple. Profit after tax is given 5 lakh and 6 lakhs. Number of shares is 40 lakhs. So that gives you 13 paise and 15 paise. Are we okay with this? Yes, are we okay with this? This is the basic EPS. All right, next. Now we are assuming that it will be converted. We are assuming that it will be converted. So calculation of diluted EPS, number of shares under the option issued at full market price, 6,30,000. That is the options outstanding multiplied by 70. That is what you are looking to uh, pay on option. So 6,30,000 into 70, but the fair value is 120. The fair value is 120. So 6,30,000 into 70 divided by 120, 367,500. Okay, next. 6,30,000 into 70 divided by 160 for the 75, 625. Issued at nil consideration, that is considered dilutive, you are having 354, 375 and 262, 500. 262, 500. That is your dilutive potential. Okay. Now, how did we get that? That would obviously be a balancing figure. Okay. This also would be a balancing figure. So 6 lakh 30 is what is converted. Out of that, at full market value, 275, 625 and 367, 500. So balance becomes issued at nil consideration and is dilutive in nature. So total number of shares 6 lakh 30. Number of equity shares for basic EPS 40 lakhs. Number of dilutive shares 354, 375. So adjusted number of shares, just add the 40 lakh to that. PAT will be 14% and 12%, 14 paise and 12 paise respectively. Since so this becomes your benchmark. This becomes your calculation of diluted EPS. Are we okay with this? Yes, are we okay? Any doubts in this? Take 2 minutes before we proceed. Yes. Fourteen paise is lower than 15, 12 is lower than 13, so you can freely report this. So this becomes your EPS diluted workings in the case of options. Now, what happens is the next one. And the next one is interesting. Let that go. Yeah. Now here, what happens is there are multiple conversion ratios. There are multiple conversion ratios. So we will have to see which one should be considered and how to do the calculation. Okay. At 30th June 20x1, the issued capital consisted of an entity. The equity share capital consisted of 15 lakh ordinary shares of rupee 1 each. On 1st October, entity issued 12 lakh 50 of 8% convertible loan stock for cash at par. Each rupees 100 nominal value of the loan stock may be converted at any time during the years ended 20x6 to 20x9 into the number of ordinary shares set out below. 135 ordinary shares, 130, 125 and 120. If the loan stocks are not converted by 20x9, they would be redeemed at par. The return equity conversion option is accounted for as a derivative liability and marked to market through P&L. The change in the option's fair value amounted to 2,500, 2,650 losses respectively. It is assumed that there are no tax consequences arising from these losses. The profit before interest, fair value movements and taxation for the year ended 30th June 20x2 and x3 amounted to 825, 8,95,000 respectively and return wholly to continuing operations. The rate of tax for both periods is 33%. Calculate your basic and diluted EPS. Okay. So now you are having multiple conversion ratios. If you convert in June 6, 1, June 7, 1, June 8, another, June 9, another. Okay. So now which conversion option you will have to select? Select that conversion option which gives you maximum number of shares or maximum dilution. So in this case, it will be 135 ordinary shares. It will be 135 ordinary shares. Are we okay with this? Yes. Now, how do we do? 8 lakh 95, 8 lakh 25. This is the profit which is given as it is. Interest on 8% convertible loan stock, we will have to deduct. So 20x2, 1 lakh into 9 by 12. And here this is there for the entire period. So 1 lakh. So that is deducted. Change in fair value 2650, 2500. Profit before tax 792, 350 and 747, 500. Subtraction. Okay. Taxation at 33% on A minus B. A minus B. So that gives you 8 lakh 95 minus 1 lakh, 7 lakh 95,000 into 33%, 262, 350. And this will be 8 lakh 25,000 minus 75,000 into 33% to give you 2 lakh 47,500. So profit before tax, after tax 5 lakh 30 and 5 lakhs. Calculation of basic EPS would be earnings 5 lakh 30 and 5 lakhs. Number of equity shares outstanding. Number of equity shares outstanding 15 lakhs and 15 lakhs. 35 paise and 33 paise. 35 and 33. This is your regular EPS. Now we move on to your diluted EPS. Now we move on to your diluted EPS. When we move on to your diluted EPS, you are going to save your interest. So add profit for basic EPS 530 and 5 lakhs, add interest and other charges. So 1 lakh plus 2650, and here it is 75,000 plus 2,500. This is basically the fair value movement which you are going to save, and 1 lakh and 75,000 is the financial cost that you are going to save, less tax relief thereon. 33,000 and 24,750. So 599, 650, 552, 750. This becomes your adjusted earnings for equity. For conversion terms, you have 4 options. So maximum number of shares you will need to select. So 15 lakhs maximum conversion at the date of issue. So 1687,500 into 9 by 12. 1265, 625. Maximum conversion after balance sheet date. 1687,500. So 3187,500. 2765, 625. That becomes your adjusted number of shares. Adjusted earnings for equity is directly this figure. So when you divide 19 paise and 20 paise, which is lower than 35 paise and 33 paise, you can go and report this. Are we okay with this? Yes. Are we okay? Since EIR is not given, splitting of convertible loan into liability and equity components as envisaged cannot be done under Ind AS 109. However, since fair values of derivatives are given, the same is considered for accounting at FVTPL. Are we okay with this? Yes, are we okay with this? Anybody has any doubts? Any doubts? The next part that we come to is presentation of EPS. Presentation of EPS. Okay. Now, when we talk about presentation, as I've already told you, this being a very significant number, it is presented right on the face of the P&L. Okay, so that it captures, it generates the attention that it deserves by the reader of the financial statements. So that is your presentation. Now, when we talk about EPS, it typically is calculated for continuing operations, discontinued operations, total operations. Three EPS numbers you will have. Now, in determination of whether potential equity shares are dilutive or not. So, presentation of EPS you will have for continuing, discontinued operations, and total operations. Total operations. Now, when I calculate my basic EPS and diluted EPS, basic, diluted. Okay, now when I calculate this, I will get I will get these three figures. Now, when I have to look at the dilution impact, I will be looking at this number. See, as I told you, if it is reducing, you report the least one. If it is increasing, do not report that. If it is increasing, do not report that. Okay, so that is something that we have. So continuing operations, basic and diluted, this becomes your control number. This becomes your control number. What do you mean by control number? It means in the case of EPS, your diluted must always be smaller than your basic, must always be smaller than your basic, or basic EPS must always be greater than diluted. Then there is an impact of dilution that is visible. For total operations, it can be anything. It can be anything, more or less, provided the control number shows the scenarios properly. So what do I mean to say is, suppose you have certain instruments. Those instruments for continuing operations are giving the calculation the way we want. That is, the diluted EPS is lower than the basic EPS. Then that analysis is over. But we report for total operations. When we report for total operations, we could be having your total operations. When we discontinue that one of the operations, in your total operations, when you calculate the EPS, it is quite possible that diluted EPS would be higher, basic EPS would be lower. This is not because of any change. This is basically going to be reported as it is. You have certain instruments in the capital structure. Report as it is. Not really concerned. Okay, but what is it? Subject to control number fulfilling the condition. Fulfilling the condition. Which condition? Control number. Control number is your representative. So let us look at a question in this regard for us to understand better. entity with discontinued operations. So I have income from continuing operations 30 lakhs, loss 36, net loss 6 lakhs, weighted average number of shares 10 lakhs, incremental common shares relating to stock options is 2 lakhs. Calculate the basic and diluted EPS. Also assume if in the case loss from continued operations is 10 and income from discontinued operations is 36, calculate the diluted EPS. Okay. So now how it is going to be calculated. Basic EPS, profit for the year, divided by weighted average number. So basic EPS for continued operations will be 1. Okay. So that will be profit from continued operations 30 lakhs divided by number of shares 10 lakhs. So that is 3. Are we okay? So this is the first step. Next, basic loss per share discontinued operations 36 divided by 10, 36. Yes, 3.6. Sorry, not 36, 3.6. Negative. Okay, overall basic loss per share. Loss. Overall means total business. 30 lakh profit, 36 lakh loss. So net is a 6 lakh loss over 10 lakh. So that is 0.6. Are we okay with this? Yes, this is the first part. Basic EPS done for the continuing operations, discontinued operations, and total operations. So that becomes your first step. Second step, diluted EPS. I have 2 lakh worth of options which are coming. So profit from continued operations 30 lakhs divided by adjusted weighted average number of shares. So 12 lakhs. So 30 divided by 12 divided by 12. So that gives you 2.5. Okay. This is on the continued operations. When I look at discontinued operations, loss from discontinued operations divided by adjusted weighted average 36 lakh divided by 12. So that gives you 3. That gives you 3. Next, overall diluted loss per share 6 lakhs divided by 12 lakhs. So that is 0.5. That is 0.5. The income from continuing operators is the control number. See, now let us look at this. Look at this. 0.6 is your basic EPS, overall basic loss, diluted loss 0.5. Diluted is 0.5. So now when we talk about EPS, what did I say first? You report only that which is reducing the profits. Yes. If it increases, reducing the EPS, if it increases, you will not report that. In this case, can I say 0.6 loss, 0.5 loss, which is higher? The 0.5 loss is higher, and therefore, if I go strictly by the rules, 0.5, 0.6, I will not report the overall diluted loss per share because it is lower. But in this case, the question arises because of a 0.5, 0.6. In this case, look at the continuing operations. Continuing operations may you typically had basic EPS 3.00 and diluted EPS from continued operations is 2.5. So basic was 3, diluted is 2.5. Yes. So your control number, diluted EPS is lower than the basic EPS, 2.5 against 3. So please go ahead and report. Your control number remains the EPS from continued operations. As long as there is no anomaly or ambiguity there, after that, whatever comes out is only going to be a reported number. But even if it is higher, you can go ahead and report. Are we okay with this? Yes. So that is your control number concept. EPS from continuing operations becomes your control number. If that is in line with the standard requirements, that is diluted EPS is lower than the basic EPS, if that condition is satisfied, then in your total operating business EPS, what is the scenario will be that you typically can report any number for basic and diluted since you have already fulfilled the control number requirement that is laid down under Ind AS 33. Are we okay with this? Yes, are we okay? Fine. Any other doubts? Any other doubts? No doubts? Okay. Okay. We now come to calculation of EPS for a subsidiary and its parent. Okay. Now, now calculate subsidiary and group's basic EPS and diluted EPS when profit attributable to the ordinary equity holders of the parent entity is 12,000, excluding any earnings or dividends paid by the subsidiary. Second, ordinary shares outstanding is 10,000. Third, instruments of subsidiary owned by the parent, 800 ordinary shares, 30 warrants exercisable to purchase ordinary shares of subsidiary, 300 convertible preference shares. So these are the two potential equity shares. Potential equity shares. Profit of the subsidiary 5,400, ordinary shares outstanding 1,000, warrants 150 exercisable to purchase ordinary shares of the subsidiary. Exercise price rupees 10. Market price of one ordinary share 20. Convertible preference shares 400, each convertible into one ordinary share. Dividends on preference shares 1 rupee per share. No intercompany eliminations or adjustments were necessary except for dividends. Ignore income tax. Ignore financial instruments also. Okay. So now let us start. So when we talk about the parent subsidiary relationship and EPS workings. So now in this particular case, how do we calculate this? Okay, so let us start with the subsidiary. Now, what is your subsidiary's profit? 5,400 basic EPS. And convertible preference shares are entitled to dividends at 1 rupee per share. So 5,400 is your profit minus 400 preference shares into rupee 1 divided by 1,000 equity shares. Correct? That is what it has. Yes or no? 1,000 ordinary shares. So this gives you rupees 5.00 per share. Okay, this is your basic EPS of the subsidiary. Basic EPS. Just a sec. Basic EPS. Now, when we talk about diluted EPS, the first thing we have to see is what are the potentially convertible instruments. So I have warrants. 150 exercisable to purchase ordinary shares of the subsidiary. Exercise price is 10, but market price is 20. So free element in warrants. In warrants. How do we calculate this? Well, I have 150 warrants which are issued, right? I have given 150 warrants. Out of 150 warrants, assuming everything will be subscribed, they will pay 10 rupees as the exercise price. Yes or no? 10 rupees as the exercise price of a warrant whose market value is rupees 20. So that means out of 150 warrants, the money that I'm going to get back is equivalent only to 75 shares. So therefore, I am having 75 shares free element. Yes, because what is this? This portion is basically number of shares at fair value. Yes. So 75 shares will be your free element. Are we okay with this? Yes. Next. If I have to calculate the diluted EPS, we start off with diluted EPS. I'm of the subsidiary only. So you had 5,000 as net profit attributable to equity shareholders of the subsidiary. That becomes the starting point plus 400. This is the preference dividend that you had, which will now no longer be reduced because you will assume that the convertible preference shares will be converted. Plus nil. This is on options exercised. Options exercised 99%, you will have no impact on the numerator, on the earnings. So 5,000 plus 400 plus nil divided by uh, number of shares. I had 1,000 ordinary shares. Now I will have 400 convertible preference shares to equity plus 400 plus 75 warrants. So that is your free element. So therefore, you will be getting 5,400 divided by 1,475. This comes to rupees 3.66 per share. Are we okay with this? Yes. You can check this. 5 per share vis-a-vis 3.66. It is match. It is lower, so it's totally fine. You can report this. Next, when we talk about consolidated EPS. When we talk about consolidated EPS. Yes. Basic EPS is equal to what is your profit? 12,000 of the parent plus I am owning, the parent is owning 300 convertible preference shares of the subsidiary into rupee 1 plus 800 equity shares into rupees 5 per share. What is this 800? The parent is owning 800 ordinary shares whose EPS ordinary was 5 rupees per share. So I'm just multiplying that because that is your part of consolidated earnings. I'm still now in the basic EPS workings only. All right. So 12,000 plus 300 into rupee 1. This is preference shares of subsidiary. Okay. Divided by yes. Divided by how many shares does the parent have? 10,000. So that gives you 12,000 plus 300 plus 4,000 divided by 10,000. So that gives you 1.63 per share. Are we okay? So this is your basic EPS. When I talk about your diluted EPS, again, start with basic 12,000 plus I hold 800 shares of the subsidiary whose EPS is 3.66 per share diluted plus I also own 300 preference shares into 3.66 plus 15 warrants into 3.66. All of these will be covered because they are diluted EPS divided by 10,000 equity shares. So that gives you 1.61 per share. 1.63, 1.61. It's lower. You can report this. You can report this. Are we okay with this? Yes. All right. Fine. So that completes a significant aspect of what is control number as well as how do I calculate when there are discontinuing, continuing, and total operations. And then we also saw calculation for a parent, the basic EPS, consolidated EPS as well. Okay. Now, all right. Fine. Next, we come to some slightly different methods of calculation. Okay. So we come to this one question that is having the impact of financial instruments also. An entity issues 2000 convertible bonds at the beginning of year 1. These bonds have a 3-year term issued at par with a face value of 1000 per bond, giving total proceeds of 20 lakhs. Interest payable annually in arrears at a nominal annual interest rate of 6%. Each bond is convertible up to maturity into 250 ordinary shares. The entity has an option to sell the principal amount of the convertible bonds in ordinary shares or in cash. When the bonds are issued, the prevailing market interest rate for a similar debt without a conversion option is 9%. At the issue date, the market price of one ordinary share is rupees 3. Income tax is ignored. Entity has accounted for convertible instruments using principles of financial instruments. Interest at 6% has already been adjusted in the profit attributable to shareholders. Calculate basic EPS and diluted EPS when net profit attributable to equity shares is 10 lakhs, ordinary shares outstanding 12 lakhs, convertible bonds outstanding 2000. Okay. Now, convertible at whose option? Issues convertible bonds. That's it. Okay. ठीक है. So let us start. So first thing first, basic EPS. You have an earning of 10 lakhs. Number of shares 12 lakhs. So 10 lakhs divided by 12 lakhs, 0.833 per share. Yes. So that is the basic EPS. Now, when we come to this question, let us try to understand how do we do the split. How do we do the split? So I will be having 20 lakhs into 6%. So 20 lakhs into 6% into 2.5312. This is present value annuity factor 9%, 3 years. This is the first cash flow stream. And then second cash flow will be the principal itself. 20 lakhs into 0.7721. Present value factor 9%, third year. So this comes to just a second. So this gives you 18 lakh 47,944. This becomes your liability component. Therefore, equity component is equal to 20 lakh minus 18.48 lakhs. So that comes to 152,056. This is not relevant for EPS calculation. This is going and sitting as your equity. Now 1847 becomes relevant because your EIR for the first year will be 1847,944 into 9%. So that gives you 166,315. 166,315. So your diluted EPS is basically going to be 10 lakhs plus 10 lakhs plus 166,315. That is your effective interest divided by 12 lakh shares. 12 lakh shares. This is number of ordinary shares plus I will have to take that 250 ordinary shares, 2000 bonds. Yes, 250 into 2000. 1166,315 divided by 17 lakhs. 0.686 per share. Okay. So this is typically one of the ways you can solve. This is typically one of the alternative solutions. Here what we have assumed is that even the principal is repayable. Even the principal is repayable. And that is why when we did the conversion activity, we did 20 lakhs into 6%. This is the coupon rate. Plus, this is for the principal that we assumed. Look at the question. The question says the bonds have a 3-year term issued at par with a face value of 1,000 per bond, giving total proceeds of 20 lakhs, interest payable annually in arrears. Each bond convertible at any time. The entity has an option to settle the principal amount in shares or in cash. So here the institute has assumed, in our calculation, we have assumed the entity will pay it in cash. But as an alternative solution, what the institute has done is it has assumed that only the coupons will be paid in cash. The redemption also will not happen in cash. It will happen by way of a conversion. So this is what was assumed by the institute. Nothing wrong in that. Absolutely correct. It is the second alternative. So in the second alternative, the profit is adjusted for the accretion of 27,338. That is, it is considering only the coupon rate. So if I look at this, 1,20,000 payable annually in arrears for 3 years. 20 lakh is assumed to be settled in equity. Since option is with the entity, it will not form part of the liability. It's the second stance that the institute has taken, which is totally fine. So what they did was they just stopped here. They did not do this. 20 lakh into 6% into 2.5312. Maybe some rounding of challenges may be there, but apart from that, it becomes the same. So equity component 1696,245. So on this, the interest will be 27,338, which they have added here. I added how much? I added 166,315 because that was what we assumed, that even the principal will be discharged in cash. So therefore, that gives you 166, but here it has taken only 27,338 divided by 12 plus 5, that is 17. So 0.6 per ordinary share. And basic anyways was 0.83. So that was the same. So here also you can report point 0.6 and conclude. Okay, so that takes care of applicability of financial instruments in your EPS workings. Okay, so with this, we take a break for around 10 minutes, 10 minutes break, and then not just 15 minutes. So it's 8:40. So we reconvene at around 8:35. So we reconvene at 8:50. Okay. Yes, break, please. Break. All right. Shall resume? Okay. ठीक है. So we come to the next topic, the next section, and that is contingent shares. And that is contingent shares. What? And this is one of the most important topic because this typically doesn't have a precursor in your accounting standard regime. So it's relatively new in that regard. So we come up with contingent shares. Okay. Now, what are contingent shares? Contingent shares are basically shares which are issued, which will be issued based on the occurrence of some event. Based on the occurrence of some event. Okay. Now, do they constitute potential shares? Answer is yes. But sir, event hoga ki nahi hoga, how do I know? How do I know if the event or the contingency that is there will happen or not? Should I forecast something? Answer is no. The standard has prescribed a mechanism as to how to deal with contingent shares. Okay, so let us come to the next topic, that is contingent shares. Contingent shares. Now, these are shares which will be issued if some contingency event that is documented happens. Okay, so basic diluted. What is the impact? So in the case of your basic EPS, shares should be included in weighted average number of equity shares from the date conditions are fulfilled. That is, shares become issuable. See, basic is always based on facts, based on what has actually happened. So if you have fulfilled the contingency condition, then the shares become issuable. So from that date onwards, you will include it in your basic EPS. Diluted EPS is more of a forecasted approach. So should I assume that or should I forecast whether the event will be fulfilled? Answer is no. That is not the mechanism that is prescribed by the standard. The standard says number one, shares are to be included in the current year only if shares are issuable considering the current period to be the end of the contingency period. To be the end of the contingency period. Okay. So whatever is my period, I will treat that to be the end of the contingency period. And if in that period I have met the contingency condition, then it will form part of my diluted EPS workings. If I haven't met the condition, I will not consider that. Is it okay? So right now, what is important for us to note is that my contingency condition fulfillment will be restricted to the period under consideration. I will not forecast it in the future. Typically, you may have a contingency condition that could exist for the next 3 to 4 years. For example, you take the case of a startup. In a startup, suppose if the parent has, if an investor has invested in a startup and the startup puts a condition, or the investor puts a condition that if you do not meet a particular targeted earnings or a particular targeted revenue, then my share will increase because it is getting riskier for me to hold. So, for example, if the target revenue does not reach 500 crores after 2 years, or if the number of users does not reach 10 million after 3 years. Okay, so these are the conditions. If these conditions are not fulfilled, then the investor will be getting additional shares from the company, depending on whatever ratio, whatever number they would have agreed upon. Now, when such conditions exist from the company perspective, it becomes a contingently issuable share. It becomes a contingent share. The company, if it does not fulfill the profitability or revenue condition, it is obligated to give the shares. So, when the company is preparing its EPS workings, will it look at the conditions from the perspective of uh, forecasting the future? Answer is no. Today, if I have not met, I will not consider. Today, if I have met, I will consider. Okay, so that is how you will have to evaluate this. Shares are to be included in the current year, assuming current year to be the end of the contingency period. Second, potential shares will be included from the date of the contingent share agreement or the beginning of the year, whichever is later. Whichever is later. And third one, prior period restatement is not needed. Prior period restatement is not needed. Okay, so that takes care of contingent shares. Let us look at one question which is important. Contingently issuable shares, ordinary shares outstanding, you have 10 lakh shares. There were no options, warrants, or convertible instruments outstanding during that period. An agreement related to a recent business combination provides for issuance of additional ordinary shares based on following conditions: 5,000 additional shares for each new retail site opened during 20x1. 1,000 additional ordinary shares for each rupees 1,000 of consolidated profit in excess of 20 lakhs for the year ended December 20x1. Retail sites opened during the year, one on May and one in September. Consolidated YTD profit attributable to ordinary equity 11 lakhs as of 31st March, 23 lakhs 30th June, 19 lakhs as of 30th September, including a 4 lakh 50 loss from a discontinued operation, 29 lakh December. So this is a calendar year question. Calculate basic and diluted EPS on quarterly as well as on annual basis. So if I have to solve this, first one, basic EPS. Your total will first do for the year. YTD profit this is. So 29 lakhs divided by how many shares do I start with? 10 lakh shares. Plus I have opened a site in the month of May. For that, I would have issued 5,000 shares. So plus 5,000 shares into May. So that is 8 by 12 plus 5,000 shares into, I opened another one in September. So 4 by 12 plus, acha, will I have any impact of the profit? Because one is for opening the retail site, the other is for profit. Profit, I touch 29, which is more than 20. So should I take it as additional 9 lakh shares to be issued? Answer is no. Because your profit is actually going to come only on the 1st of April, earliest. Right? So it will be met only in the next year. So that is why this will become 0. So therefore the calculation will be 29 lakh divided by 10 lakh 5,000. So that becomes 2.89 per share. 2.89 per share. Is it okay? So that is your basic EPS. Next. Diluted EPS. 29 lakhs divided by this total of the denominator is 10 lakh 5,000. Okay, so that will be the starting point for diluted EPS. 10 lakh 5,000 shares plus. Can I say this 5,000 shares which was issued for 8 months was potential for 4 months? So you will have 5,000 shares into 4 by 12. They were actually in issue for the full year. They were actually in issue from May onwards. But you had the contingency agreement that was in place, and therefore it was potential for 4 months. Plus, can I say the second case? 5,000 shares into 8 by 12. Why 8 by 12? 8 by 12 typically becomes January till August it was potential. September you actually issued. So 5,000 into 8 by 12 plus the profitability condition. 1,000 shares for every 1,000. So basically 1 rupee, 1 share. I mean, I'm just giving the ratio. So you exceeding 20 lakh of profit. So I have made a profit of 29 lakh. Can I say this was potential? Yes. Can I say this was met until the contingency period got over? Answer is yes. Can I say this is potential and meets the contingency condition? Answer is yes. So I will have to consider that. Plus 9 lakhs. From which date? From which date? Well, this would be considered from the beginning. Yes. So this comes to 1.52 per share. 1.52 per share. Are we okay with this? Yes, sure. So did you get the difference? Yes, between basic and diluted. Okay. Now, retail contingency, they are only interested about opening the store, not whether it operated or shut down during the year, etc., etc. Okay. So considering current year to be end of the contingency, these two were prepared and discussed. Okay. Now on similar basis, if I have to do it on a quarterly basis, this was for the year. Now quarterly, I have Q1 11 lakhs. Yes. Q2 12 lakhs. Q3 19 minus 23 minus 4 lakhs. Q4 10 lakhs. 29 minus 19. So 10 lakhs. So now we move on to basic EPS, diluted EPS. Basic EPS and diluted EPS. Now, Q1, your profit is 11 lakhs. Your number of shares is 10 lakhs. Site also not open, profit also not met. So this comes to 1.10 per share. If I look at diluted EPS, 11 lakhs divided by 10 lakh shares plus nil plus nil. 1.10 per share. Is it okay? Yes. Why 1.10? Why no change from basic? Because right now neither a retail store is open nor have you met the profitability condition. So assuming Q1 to be end of the contingency period, both the contingent conditions have not been met and therefore both the shares are 0 and 0. Okay. Q2, 12 lakhs divided by 10 lakh shares plus a retail site was opened on 1st of May. So May and June, 2 months it was actually there. So 5,000 into 2 by 3 plus nil. So that gives you 12 plus 10, 12 lakh divided by 10 lakh 3,000. So this gives you 1.20 per share. 1.20 per share. And here this will be 12 lakhs divided by, you start with 10 lakh 3,333 shares plus. Can I say this 5,000 was potential for 1 month? Yes, it was. So that gives you 'And then did it meet the profitability condition? Answer is yes. You earn 23 lakhs. So end of the current period is end of contingency period. You are at 23, so 3 lakhs into 3 by 3. So that gives you 13 lakh 5,000 shares. So 12 lakh divided by 13 lakh 5,000. Next, Q3. There is a loss of 4 lakhs. 10 lakh shares plus 5,000 of the earlier quarter, now there for the full quarter. 5,000 into 1 by 3, because in September a new store was opened. Yes, next. 4 lakhs loss. Here also 0.40 per share. Next, 10 lakh 6,667 plus 5,000 shares plus into 2 by 3 plus 0. 0.40 per share. If you do the, so here it is 0.4. Question is, shall I report this? Well, if the diluted is lower, you should not. But here they are the same. No, they aren't. थोड़ा सा rounding off का gap है, right? If you extend the decimals, you will notice that one is higher, one is lower. These would typically be dependent on the control number. So you will have to check whether the EPS from the continuing operations follows the rule of diluted being lower than the basic. If that is the rule, then here there is no challenge. Okay, we can continue to report whatever is there. Okay, so you can verify that independently. Q4. 10 lakhs divided by 10 lakh shares plus 5,000 shares. 5,000 shares plus 0. So this is 0.99 per share. Here also profit is 10 lakhs for this quarter. 10 lakh 10,000 shares plus 9 lakh into 3 by 3. So that gives you 0.52 per share. Okay, so that kind of resolves the major topic of contingently issuable shares. Okay, contingently issuable shares, very important because of the various technicalities that are there, but otherwise it's not so difficult. Okay, fine. So that closes this part. Then the next one that we get back to is now we get back to just a minute. Just looking for one particular topic. Yeah. See, written put options. Written put options. What does this mean? This means a contract by an entity to repurchase its own shares. That means buy back its own shares. Company has written these options. That means somebody has a contract to sell, and we have written that contract. That means we have accepted that contract. Okay, such as return put options and forward purchase contracts are reflected in the calculation of diluted EPS if the effect is dilutive. If these contracts are in the money, that is exercise price or settlement price is above the market price, then the potential dilutive effect shall be calculated. Yes. It shall be assumed that at the beginning of the period, sufficient ordinary shares will be issued at average market price during the period to raise proceeds to satisfy the contract. It shall be assumed that the proceeds from the issue are used to satisfy the contract, that is to buy back ordinary shares. The incremental ordinary shares shall be included in the calculation of diluted earnings per share. Okay. So assume that an entity has 160 written put options on 160 of its ordinary shares with an exercise price of 10 per option. The put obligation is therefore 1,600. That's right, 160 into 10. Average market price is 8. In calculating diluted EPS, the entity assumes that it issues 200 ordinary shares at 8 per share to raise the proceeds necessary to satisfy the put option. The difference between 200 and 160, that is the 40 shares, is added to the denominator in calculating the EPS. No adjustments made to numerator because shares are deemed to be issued for nil proceeds. Okay, so fairly clear, nothing different. Only thing is here, we are entering into a contract to buy back. So what extra we pay versus what is the actual worth we are getting back, that differential is what goes to the that difference is what will be treated as your free element. Okay, so that is all about written put options. And with this, we come to a close on the exclusive items for CA final. Okay, so I think we have done quite a number of questions, quite a number of adjustments, quite a number of discussions. We went through what you call as what is the numerator in the EPS calculations, what is the denominator, and then we saw participating preference shares, and then diluted EPS we have seen, and we have seen options, warrants. We haven't we saw the presentation of EPS, the concept of a control number in the event of a loss, and we also saw contingently issuable shares and written put options. Okay, so these are the coverages that we could achieve. Yes, it has been at a fast pace, but I think you will definitely understand because that is particularly for revision. This is particularly for revision. Okay, so now with this, let us come back to our questions on bonus and rights issue, etc., etc. Okay, so that is done. Okay. So now we come back to our topics, which typically is something that you have studied in your inter. Okay, largely this session will focus on that. Okay, so that it gives you a kind of refresher, and also we complete the standard in totality. Okay, now when we talk about EPS, yes, so we can quickly run through these questions, or we'll do some of these. Yes. Let us look at the calculation of weighted average number and also the calculation of your EPS. Okay, in a financial year, Ravi Limited issued 80 lakh rupees equity shares at par on 15th December. It also bought back rupees 20 lakhs equity capital at par on 1st March. The equity capital was 150 lakhs at the end of the year 31st March. Calculate the weighted average number of equity shares outstanding during the period. If the face value of each share is rupees 100. Compute basic EPS if the net profit attributable to equity shareholders is 10 lakhs. Okay. So now close. I have issued during the year, I have bought back during the year, and I have closing during the year. So opening capital will be 90 lakh rupees. Okay, just look at this. This is a simple done. So 90 lakhs, simple. Next, computation of weighted average number of equity shares. 1st April, start of the financial year. 15th December, uh, and finally 1st of March. Okay. So equity capital 90, 80, 20. So in terms of number of equity shares, 90,000, 80,000 minus 20,000. Okay, that is the buyback. Period outstanding 12 months, 3.5, 1 month. So that gives you 1,11,667 weighted average number of equity shares. If for some reason you are not comfortable with this particular manner of calculating weighted average, you can do it on a timeline basis also. Starting 1st April, 90,000 shares. Then 15th December, 80,000 got added. It became 1,70,000. Then 1st March, it got subtracted. So that comes to 1,50,000. So the time duration is also plotted 8.5 months, 2.5 months, 1 month. And here the weighted average number will be by 12, 1,50,000 into 1 by 12. So that gives you 63,750 plus 35,417 plus 12,500. So 1,11,667. So you can have a look here. Both are the same. Both are the same. Both have same run. Are we okay? Yes. So rupees 8.96 per share. Yes. So this is done. Now, compute weighted average number of equity shares in the following case. April, June, Jan, March. Balance of equity shares. Equity shares issued for cash. Equity shares bought back. Balance of equity shares. Yes. So go through the solution. Yes, if you have any issue, whichever method is comfortable, you can adopt. Yeah, go through this. Just a minute. All right, fine. So again, same manner of solving. Yes, you can take it 1st April, 30th June, 15th Jan, do it in a tabular form, or you could do it on a timeline basis. I would be more comfortable with a timeline basis. The reason being that it's a movement that you can see, that you can visualize, that you can imagine over a time period. And at the same time, you will not miss out on any of the events. In a tabular presentation, there is a risk that you may miss out on a number of on one or two events. And if that is the case, then you would be in a difficult situation in the examination. That deficiency is generally, I find the timeline to overcome that deficiency. So, anyways, the choice is yours. Okay, you may choose this or you may choose the alternative presentation. Okay, all right. Now we move on to the next one. This is considering the partly paid shares, which I had given an example to you. Okay. So during the year ended 31st March, Jayant makes a public issue of 1 lakh equity shares of rupees 10 each, which was fully subscribed. The calls were made as 5 rupees on application and allotment on 1st July, 2 on first call on 30th September, 3 on second and final call made on 1st of January. Partly paid shares are entitled to participate in the dividend to the extent of amount paid. Company had 5 lakh shares at the beginning of the year, and apart from public issue of shares, there were no other changes in the share capital. Compute the weighted average number of equity shares. So 1st April, I have 5 lakh shares. This is fully paid up 100%, therefore 12 months. So 5 lakh. 1st of July, I have issued 1 lakh shares. Paid up is 5 divided by 10, 50%. So this is there for 9 months. So it will be 1 lakh into 50% into 9 by 12, 37,500. Then 30th September, another 2 rupees is called. So 20% into 9 months, into 6 months, into 6 months. So that gives you 10,000. And 1st of Jan, so 1 lakh into 30% into 3 by 12. So that gives you 7,500. 5 lakh 55,000 becomes your weighted average number. The key point to remember is this. Because it is partly paid, we are taking it on the proportion of the full value, on the proportion of the full value. Okay. So that resolves question 8. I mean, this, yeah. Okay. But I can leave this one question to you for homework. Yes, these are material are already uploaded on the portal. You can go through that. Yes. At the beginning of a financial year. Okay. Okay, now we come on to the next one, that is bonus and rights issue. Because Wayne's is done, this is done. So more or less, I think we are comfortable with understanding the calculation. So now we just revisit the working of bonus shares, because that is something which is interesting and something which you have done, but maybe I could just add in 2 cents as part of today's revision. So compute basic EPS based on the following. Number of equity shares outstanding at beginning 5 lakhs. Bonus issue on 1st October of current, 3 shares for every 1 share held. Net profit for current financial year is 160 lakhs and previous financial year is 50 lakhs. So now you will have to calculate the bonus, the impact of the bonus shares in this particular scenario. Okay, since bonus is an issue without consideration, the issue is treated as if it had occurred prior to the beginning of the previous reporting period. That is the earliest reported period. Computation is as under. Okay. Number of equity shares outstanding at beginning 5 lakhs. Total number of equity shares outstanding with the bonus. Bonus is 3 for 1. So 5 lakh plus 15 lakhs. So that gives you 20 lakhs. Basic EPS 1.6 crores divided by 20 lakhs, 8 per share. Adjusted EPS for the previous year. This becomes crucial for us. Previous year, I would have reported 50 lakhs divided by 5. 50 lakhs divided by 5 lakhs, right? Because I did not have the bonus. But now that 5 would become 5 plus 15, so 20 lakhs. So 50 by 20, 2.5. So that is what is your first thing. Okay. Next. At the beginning of the reporting period, Advait's Limited's equity share capital was 10 crores, divided into shares at of rupees 10 each. During the financial year, it has issued bonus shares in the ratio 1:1. Net profit after tax attributable to equity holders for previous and current financial year is 8.5 crores and 11.5 crores respectively. EPS disclosed in the above notes in the accounts for above 2 years is 8.57, 3.75. Comment on the EPS calculated above. So number of equity shares outstanding at beginning of current period is 1 crore. Total number of equity shares outstanding, that is 1 crore plus 1 crore bonus shares, because it's given to be in the ratio of 1:1. Basic EPS for current year, net profit for the year 11.5 crore divided by 2 crore. Adjusted EPS for the previous year, net profit for the opening period, for the net profit for the previous year divided by total shares as per step 2. So net profit for the previous year is 8.5 crores divided by 2 crores, 4.25. And this is 11.5 by 2, 5.75. 5.75 is right. Previous year 8.5, they have not done a restatement. They should do the restatement as per Ind AS 33. So that closes. Okay. Next. Next. All right. The following information is furnished by Samantha. So now bonus return. The bonus we saw, we restate current and previous year both by incorporating the bonus at both the sides. Okay, so that it will be giving me the correct comparable amount. Okay, now coming to rights issue. In the rights issue, just a minute. I need to just pull back something. Okay, fine. Think that it is captured here. Okay. The following information furnished by Samantha for financial year 1920 and 2021. You have 22 and 30 lakh respective profits. Rights issue is done, one share for each 5 shares outstanding. Number of shares outstanding prior to rights 10 lakhs. Rights issue price is 25. Fair value of one share immediately prior to rights exercise is 32. Last date to exercise rights is 31st July 2020. Compute basic earnings for 1920, restated basic earnings for rights issue, basic earnings for 2021. So what do we do is we calculate something known as the X rights price. That means if I exclude the rights, what will be the X rights, theoretical X rights fair value. So base shares quantity 10 lakhs into 32 plus rights issue 2 lakhs into 25 divided by 10 plus 2. So that gives you 30.83. Adjustment factor is 1.04, which is basically fair value before the rights issue divided by theoretical X rights price. Weighted average number of shares outstanding during the period. 1st April to 31st July, 4 months, and then 8 months. Time weight 4 by 12, 8 by 12. Adjusting factor for all the periods prior to the rights issue, I will multiply that by the adjusting factor. Why not for those which are after the rights issue? Because there it's already captured as part of your share capital. So nothing will come for these periods or these tenures. Okay. The number of equity shares 10 lakh in first case, 12 lakh in second case. Vains is going to be the multiplication. So it will be basically 4 by 12 into 1.04 into 10 lakhs, 8 by 12 into 12 lakhs. So 1145, 946. So that is your weighted average number of shares outstanding during the period. Okay. Next, basic EPS for 2020, 2021. Okay. Next, basic EPS for 2020 and 2021 will be 30 lakhs divided by this 11 945 946 2.62. Reported basic EPS would be 22 lakhs divided by 10, so that is 2.2. Adjusted basic EPS 22 lakhs divided by 1037 838 2.12. 2.12. Are you able to follow? Yes. Are you able to follow? Any doubts? No doubts? Yes. All right. So that, all right. Similar lines, compute basic and adjusted EPS from the following information. 22 lakhs, 33 lakhs, 1 lakh 10,000, 270. Rights issue, one share for each 4 shares outstanding. Rights price 180. Last date to exercise the rights 31st July 20x2. Okay, so just go through this. I want you to solve it as it is. It's similar to the previous question exactly, only figures are different. Okay. Yes. Yep. Done. Yes. All right. Okay. Okay. Then there is one concept, the last part of today's discussion, which is typically not directly given in your study material, but something which has come once in the exam. Okay. And that is, if I have multiple instruments which are dilutive in nature, and how do I actually do a categorization? How do I actually do a categorization to find out which combination of instruments gives the maximum possible dilution? Because that is something which you will be reporting. There may be some instruments which may not give a complete dilution. Okay. So that is the last part of today's session. Okay. I'm just looking at that question. Okay. I think this is the one. Mm. Yeah. So we can do this. Yeah. Question 20 and 21. Okay. All right. From the following information of Bhadrachalam, determine the order in which dilutive potential equity shares should be considered in the computation of diluted EPS. Just remember that for these questions, do not bring financial instruments, because here I'm explaining a different concept. So I'm not integrating it with financial instruments. Net profit attributable to equity holders is 1.5 crores. Number of equity shares outstanding during the year is 25 lakhs. Average fair value of one equity share during the year is 100. Details of potential shares optional 1,20,000 shares with exercise price of 75. Convertible preference shares 10 lakh entitled to a cumulative dividend of 8 per share. Conversion ratio is 4 equity shares for every preference share held. 15% convertible debentures of 100 each, 12 lakhs. Each debenture entitled for 2 equity shares. Assume corporate tax rate 30% and dividend distribution tax rate is 10%. Okay. So now what we have to do is we will have to first calculate the incremental EPS because of the instruments. So I have how many instruments? I have 3 instruments. 1, 2, 3. Options, convertible preferences, convertible debentures. When I talk about options, additional net profit after adjusting? No. Additional number of equity shares included for diluted EPS, 30,000 equity shares. Okay. Earnings per incremental share will be 0. How did I get this 30,000? Well, you have options with an exercise price of 1 lakh of 75, whereas your fair value is 100. So I got 1,20,000 shares. So in fair value terms, how much that comes to? 1,20,000. 90,000. So though I have they have subscribed to 1,20,000 of my shares, the fair value is only for 90,000. 30,000 becomes your shares issuable under the option. 30,000 equity shares. Next, 10 lakhs into 4 equity shares. So 40 lakh shares. Convertible debentures. Okay. Net profit impact. Preference dividend 8 into 10 lakhs plus 10% DDT. 88 lakhs. Here, debt interest 12 lakhs into 100 into 15% into 100 minus 30 is equal to 1.26 crores. Okay. Additional number of shares, 15% convertible debentures of 100 each, 12 lakhs into 2, 24 lakh shares. So earnings per incremental share is 5.25. 5.25. Okay. So priority in sequence, least to highest, 1, 2, and 3. Okay. Now, when I do the working, net profit as given 1.5 crores and 25 lakhs. Earnings per share. Adjustment for options, nothing, but 30,000 shares is come. So that will be added. So 1,50,000 divided by 25 lakh 30,000. 5.93 dilutive. Next. Preference shares adjustment. ₹2.38 crores. $88 lakhs. Profit. 40 lakhs number of shares. So when I add and divide 3.64, this is again dilutive. Adjustment for debentures 126 and 24 lakh shares. So 364 and 8930. So 3.64, 4.08. So this becomes anti-dilutive. Why? Because it has increased from the last dilute share working. That means it has gone up from 3.64 to 4.08. That means in reality, debentures in this particular case are not having a dilutive potential. So we will exclude that and we will report only 3.64 as your diluted EPS. Okay, so that is something which you will have to consider. So typically when you have multiple instruments and you are forced to take a call, that means which one should I report, which one should I not report, how do I make, or should I consider everything, then what you should do is you should take the incremental EPS of each class of potential shares, rank them from least till the highest, and then you start working with the basic EPS, add the first potential in the numerator and the related profit in the denominator to give you the total, then the next, then the next, then the next. So that cumulatively is going to give you a kind of a mechanism wherein you can arrive at the lowest possible dilution and also have a look at the dilution that is going the other way. That means it becomes anti-dilutive. And once you do that, where you stop, where the dilution stops, that will be the place for you to report. Okay. So that takes care of question 20. So we look at question 21. From the books of Janet, the following information is available: fully paid shares, partly paid shares, options outstanding at 60, 10,000, average fair value is 75, 10% convertible preference shares of rupees 100 each, 80,000, conversion ratio 2 equity shares for each preference share, 12% convertible debentures for 100 each, 10,000, conversion ratio 4 equity shares for each debenture, income tax rate is 30%. On 1st October, partly paid shares were fully paid up. On January, the company issued one bonus for 8 shares held on that route. Net profit attributable to equity holders for years 1 and 2 were 10 lakhs. Calculate basic, diluted, adjusted, and diluted EPS for X0, X1. Assuming same information for previous year. Also assume that partly paid shares are eligible for proportionate dividend only. Yes. So I want you to go through this working as well. It is quite similar to the previous one that we had done. Okay. Yes. All right. So coming back to this, fully paid shares 1 lakh, partly paid shares when we have adjusted. First year it was partly paid, second year it was partly paid for half year, and then it became fully paid. So that is adjusted. 1 lakh 50, 1 lakh 75 without bonus. Add the bonus in both the sides, so 175 and 2 lakhs. Then add bonus for convertible debentures. You will have to consider, yes, and add bonus for convertible preference shares as well. That also will be considered. So total Vains is 2 lakhs and 2 lakh 25 for diluted EPS. Okay, so that becomes your weighted average number. Computation of basic EPS and adjusted basic EPS. Net profit 10 lakhs, 10 lakhs, 10 lakhs. No adjustment needed. This is the net profit as given. Vains 150, 2 lakh and 175. So 6.67, 5 and 5.71. Straightforward working, nothing to be done. Okay. Then we move on to incremental shares to determine the ranking. So options, no impact on earnings. Convertible preference shares 80,000 into 100 into 10%, 8 lakhs. 100% minus tax rate, so 70% into debenture interest. So that is 10,000 into 100, 10 lakh into 12%, 1 lakh 20 into 70%, 84,000. Additional number of equity shares, options 2,000, preference preference dividend, or rather your additional number of shares. So 80,000 into 2 is what they have given. Convertible preference shares, 2 equity shares for each. So 80,000 into 2. Debentures is 4. So 10,000 into 4, 40,000. So that gives you additional number of equity shares. Earnings per incremental share nil, 5, 2.1. Okay. So that is basically 1 divided by 2. So options is always ranked 1. Earnings per incremental share is 5 and here 2.1. So 1, 2 and 3. So when I do my working, I will start with net profit. Then I will take first rank options, then second rank convertible debentures, and then third rank convertible preference shares. And then we will look at the impact. So net profit as given, adjustment for options that declines your EPS. Okay. Next, adjustment for debentures. Yes. 40,000 adjustment for preference shares. Yeah. So 84, 8 lakhs, 84,000, 40,000, 40,000, 40,000. Here 8 lakhs is added, 160, 160, 160. That is your weighted average number. So after preference shares adjustment, so here you can see this, it is turning anti-dilutive. It is turning anti-dilutive. Here also it is turning anti-dilutive. So this is how you will typically do your workings. This is how you will typically handle your workings. This question has not really come in any of your exams, okay? But this was part of your inter. So just revisit. But typically, the likelihood of this question, it's come just once in one of the exams. Apart from that, it hasn't really seen light of the day. So therefore, I'm also a little not confident how much it's really important. Yes. So in that sense, yeah, so we have covered kind of everything that is there for your revision. The last part after the break, particularly, we covered, just give me a minute. I can call for the TIs. All right. So with that, I think we conclude the session. The most important part was what we did initially, and that dealt with our CA final topics, that is your contingent shares and your participating preference shares, and also, what we had was diluted EPS, net profit attributable to equity shareholders, adjustments, and presentation of EPS, the control number, and calculating the EPS in the case of a parent and the consolidated group, parent, subsidiary, and the consolidated group as a whole. So that is something which we had gone through, and those are the most critical areas for your understanding and for your implementation. So with that, I think we conclude today's session. Yes. Anything else that you have a query? I see one student here, Laksh. Do you have any query? Yes. Otherwise, we can end the session. All right. So no query. So we conclude the session, please. Yes. Thanks. Thank you. Thank you.